Reda Ferran, Head of Content at Finimize, formerly Equity Analyst at Fidelity. Welcome and thank you for joining me.
Thank you, Carl. I'm very happy and excited to be here.
Let's get right into the meat of what's going on. So, I love to start with this question. What's the biggest story in financial markets investors should be paying attention to right now?
Ooh, I think there are a lot of different options or a lot of different stories. If I had to pick one that's a little bit flying under the radar, is maybe it's more of a geometry issue as opposed to financial issue, but we're talking about the shape of the US economy. And it's this talk about a K shaped economy. And this is, if you really picture the letter K, right, you have one arm kind of going up and one arm kind of going down. And this is the situation the US economy is in at the moment. So on one hand, you have the haves who, the top 10, 20% of Americans who have seen their financial well-being increase because this particular group of people are invested. So they're, heavily invested in stocks. They own a lot of other assets, real estate, you name it. Obviously, financial markets have done well. Also, asset prices have gone up a lot in recent years. Therefore, they have gotten richer. They feel richer. They're spending accordingly. And actually, if you look at the statistics, the top 10% of Americans today account for around 50% of total US consumer spending. That's the highest level in data going back to as far as 1989, and it's up from about 37% 3 decades ago. On the other hand, if you look at people who are the have-nots, should I say, so the people who are on at the bottom end of the kind of income and wealth spectrum, they're really struggling. They've seen their pandemic era savings largely dry up. They are increasingly having to, spend a bigger and bigger portion of their income on essentials such as utilities, food, and so on. And they're increasingly having to borrow just to make ends meet. And now also they're starting to fall behind on their debts. Actually, there's a statistic that came out, I think, last week or 2 weeks ago, basically on the delinquency rates of US households. It shot up to the highest level since 2017. And if you actually zoom in on the data, it was really the lower income households and students that are falling behind on their debts at the moment.
The really interesting thing about all of this is we saw it coming 5 years ago, right? Whether it's us, whether it was other economists and analysts, we all flagged the risk of a K shaped economy coming out of the pandemic where the rich got richer and the poor got left behind. When you have a large, unsatisfied population who can see themselves getting poorer, struggling to make ends meet, well, that's ripe for political disruption, for internal disruption, and that's been playing out on the global stage. There's a set of questions here around the US, given valuations and geopolitical risk, and whether international stocks look particularly attractive, or by international, I mean non US right now.
100%. Touching on our earlier chat where the US economy is increasingly depending on, a small subset of people, the US stock market is increasingly depending on a small subset of tech companies. I don't think that's a concentration risk that's wise for your average investor, personally. And actually, if you look at 2025, some of the best performing stock markets in the world were nowhere near the US. So you're talking about Spain was one of the top performers, South Korea, and actually, South Korea is starting to look very interesting. And basically, if you look at the stock market over there, there's a huge weighting towards two memory companies, so SK Hynix and Samsung. And actually, if you are looking at the next potential way to play the AI boom, it's memory. Memory has now become the biggest bottleneck, if you think about it, in deploying AI and building out AI data centers. And if you look at South Korean stocks and their valuations there, they're much cheaper than US stocks at the moment. So here's an interesting way to continue playing, let's say, the AI boom, but via an sometimes overlooked market, and more importantly, a much cheaper market compared to the US. And I think that's the key thing in terms of looking at opportunities when you look about international opportunities compared to the US, is that the international markets, international stock markets, trade at much lower valuations than the US. And while valuations might not matter in the short run, there's a lot of academic research that shows that your long run return is heavily dependent on valuation levels when you enter the stock market. in the sense that if you enter, let's say, you invest in the US right now, where valuations are quite elevated, on a 10-year time horizon, your returns might not be as attractive versus if you enter another stock market where the valuations are a lot more attractive. So if you're putting on, your long-term hat, which you should do as an investor, I think you should be quite sensitive to valuations. And at the moment, valuation levels in international stock markets are a lot more appealing than in the US. And they're not as concentrated as the US stock market at the moment.
Putting that all together, it's not just consumer spending that's in a K shape, it's also the US economy and the US stock market, right? So you've got the biggest stocks in the S&P 500 driving the lion's share of the returns and have been for a while. The rest of the other 493 stocks are just also rans, if not detractors, net from performance. And so you've got a massive K-shaped risk there. You've also got the tech capex AI cycle being a massive driver of the US economy. Again, everything else by comparison, bar one or two spots, is also an also ran, if not a detractor. And then, of course, you've got consumer spending. How do you step through all of the potential doom and gloom? And how does that help you when you're explaining to Finimizers what's going on without inducing panic?
Fantastic question. So, two parts to that in terms of how we help Finimizers really kind of navigate all of this. I think the first part is, helping them look beyond the top line data and trying to help them really understand the underlying data. So again, talking about this K-shaped economy. So if you look at US GDP numbers or US economic growth numbers, they look completely fine, right? And if we were to just completely report purely on that, hey, the US economy expanded by, whatever, 3% last year, amazing, blah, blah, blah. I feel like we're not really doing our job because it's our job to really dig into the underlying data. And the problem with these, a lot of these economic numbers and data that gets released, and people sometimes forget this, is that these are averages, and averages can mask a lot of, different or divergent data underneath. Then the second thing we do is we try to make all of this practical. So what does this mean for your portfolio? How can you make your portfolio more resilient in light of all of these? So whereas, early on, or let's say like 1-2 years into this, AI euphoria, and everyone was like recommending big tech stocks and so on. It's not like we were not recommending them, but we were saying, hey, don't forget diversification is the only free lunch you have in investing. And we're always hammering home the concept of diversification, not just purely on sectors, as in don't be overly concentrated in tech, but also on geography. That's super important. If you look at, the 2010s, US stocks, absolutely really outperformed international peers, right? And if you think about a lot of young investors in their 20s, maybe in their 30s, they probably don't remember a time when US stocks didn't, outperform international stocks. But actually, and I remember this is like a piece I wrote years ago making the case for international diversification, is that actually if you don't just focus on this kind of short time frame, if you actually look at a much longer historical period, so let's say since the 1960s, 1970s, actually the last decade was sort of the exception and not the norm. And actually a lot historically international stocks have outperformed the US in many different periods. So don't forget that perspective, and don't forget international diversification, for example. So that's something we've been really trying to hammer home in recent years. So I think that's something we also do quite well. We don't try to just chase the trend and just recommend whatever is working at the moment, AI stocks, tech, US stocks, you name it. We always try to get people to think about proper risk management and how to build a sensible portfolio and a well diversified portfolio, which once again, like I said, diversification, it's the only free lunch you have in investing, so you might as well eat it.
And so, a perfect segue, and I promise I haven't planned this, into looking at the most pressing questions we are getting from retail investors. And right now, there is one that's head and shoulders above the rest. So, are we in an AI bubble?
The $1 trillion question, if you ask me. I think it's very hard to generalize like that, like to just give an things are not black and white in life and in investing. And I think to just outright say we are in an AI bubble or are we not is not the correct way to approach it. I think some areas of the market or AI market, perhaps definitely look quite bubbly, some not. Honestly, all these forecasters that sit here, they tell you the S&P 500 is going to end 2026 at this level, gold is going to end 2026 at this level. Honestly, I wouldn't listen to them at all. I think no one can forecast the future. And I think your job as an investor is to be honest with yourself and recognize and admit this fact that you don't know what the future holds. Then, in light of that, the correct approach or my philosophy is, hey, because I don't know what the future holds, let me build a resilient portfolio that can withstand many different futures. That means don't be overly concentrated in tech stocks and AI stocks and all that, but can also withstand, that perhaps we're not in an AI bubble. That means you are invested, you do own stocks, and you ride the next wave potentially. So I think that's always been my philosophy, and that's how I manage my portfolio personally.
I'd love to switch gears to a project I know is close to your heart, which is the Finimize Substack piece of work and the Finimize Analyst Desk account on Substack. Now, we always talk a lot to partners about meeting retail investors where they are, in their channels, where they're spending time. And I'd love for you to maybe share what the thinking is with the Analyst Desk on Substack and how we are meeting investors there.
About a year and a half ago, or slightly more, obviously our analyst team here at Finimize have been doing some kind of longer, more analytical, slow moving research pieces on interesting investment ideas that we have kind of come across. I already touched on Russell's piece on South Korea, for example, and all that. So the idea with Substack was basically to take these research pieces that we're producing and still deliver it, but deliver it via an email format, essentially, because that's ultimately what Substack is, right? You're sending out emails, but then these emails don't just get lost forever. They also live on your Substack page, which kind of looks like a blog as a way. And it's not just the research pieces themselves. We also make it very clear, very transparent, where anyone who subscribes either to Substack or to Finimize Pro can access, in one convenient spreadsheet, every single trade idea that we've put out there, what date it was opened, what date it was closed, if it's been closed, most importantly, the performance. And we show them the average performance of all our investment ideas. And something very important related to this is we don't sugarcoat it. We don't purposely pick the top 3 ideas that have done well. No, we show you the actual average performance on all our investment ideas, the ones that did well and the ones that didn't kind of do well. So that's a conscious decision that we've taken to basically make it focused. And to be extremely honest with you, because I've seen a lot of other Substackers doing this, so providing investment research and deep dives into stocks and so on, charging perhaps more than we charge. They have, granted, we've only just started like 1 month ago, 2 months ago, but so these other Substackers have a lot more subscribers. And then when I look at their content, I tell myself, hey, we actually produce stuff that is way better than this. And so why don't we, get into this market? Because I do think we have better research. And yeah, I think we can take market share there essentially.
Market share is one thing. I kind of think that's secondary to almost having a moral duty. If I think back to when the newsletter started, it was to give people context and clarity around what's going on in financial markets, how to digest that information and what to do next. And we did that because it wasn't happening for people. That didn't exist in the market. Unless you had a friend who ate the FT for breakfast and could explain it to you over dinner, you were in the wind. And so here, if you look at Substack, and in your experience, you're seeing people getting short shrift from the content that they're perhaps paying for or subscribing to. And we know we have high quality, verifiable research. It's our job, duty, mission to get that in front of those people. Market share be damned. And if we drag up the standard for everyone else, then Sure, it's more competitive, but that's a better outcome for retail investors.